Today's topic is the federal income tax treatment of debt. I'm Leandra Lederman.
And I'm Stephen Mazza, a tax law professor and the dean at the University of Kansas School of Law. And it's time to break into tax.
This video will cover four main topics. First, the federal income tax treatment of borrowing and the repayment of loan principal.
Second, the borrower's consequences when debt is forgiven.
Third, how debt is reflected in the acquisition of property.
And fourth, how debt is treated on the disposition of property.
So let's start with the federal income tax treatment of loan proceeds. They're not included in the gross income of the borrower.
Why is that?
So by taking out a loan, the borrower is required to repay that at a future time. So the generally accepted rationale is that there's no gross income on borrowing because of that offsetting obligation to repay. The taxpayer is not really richer if the taxpayer borrows $25,000 because the taxpayer has an obligation to repay that $25,000 in the future. So what are the tax consequences when that borrower actually repays the loan?
Well, when the borrower repays the loan proceeds back to the lender, the borrower is not entitled to a deduction. The repayment of the loan just makes good on the initial borrowing.
Right. Keep in mind what we're talking about here is the loan principal. We're not discussing interest. If the borrower also pays interest on the loan, that may or may not be deductible. It generally depends on what the borrower used the loan proceeds for.
Let's move on to loan forgiveness. The tax treatment of loans we've discussed so far generally assumes that the taxpayer will repay the full amount borrowed. But what result if the taxpayer fails to repay the borrowed funds?
So as a general rule, loan forgiveness is included in the borrower's gross income. Let's take a look at Code Section 61A11. So Code Section 61 is headed Gross Income Defined, and the definition of gross income includes the following items. And number 11 is income from the discharge of indebtedness. The logic behind this is that cancellation of indebtedness is an accession to wealth for the taxpayer. So if the taxpayer borrowed $25,000 but only paid back $15,000 and the other $10,000 was canceled, the taxpayer is actually $10,000 richer.
Nonetheless, some cancellation of indebtedness may be excluded from gross income.
Code Section 108, Income from Discharge of Indebtedness, provides rules on this. For example, it provides that gross income does not include cancellation of indebtedness if the discharge occurs in a Title 11 bankruptcy case, or if the discharge occurs when the taxpayer is insolvent, which means when the taxpayer's liabilities exceed the fair market value of the taxpayer's assets. We should also note that when Code Section 108 excludes COD income from the taxpayer's gross income, it usually requires some reduction of the taxpayer's tax attributes. And this might, for example, be a reduction in the taxpayer's basis in property.
Not all debt discharge results in COD income. Cancellation of debt may be a medium for some other sort of transfer, such as compensation income or possibly a gift. For example, if an employer forgives $10,000 of debt owed by the employee to the employer and does so as compensation for services performed by the employee, the debt discharge would be treated as wage income, and it would not qualify for one of the exclusions under Code Section 108. If a parent lent money to a child and then forgave the debt, the transfer might be treated as an excludable gift, depending upon whether it met the legal standard for a gift under the Supreme Court's decision in Commissioner versus Duberstein.
Let's now turn to the tax treatment of debt in the context of acquisition of property. Code Section 1012 says that the basis of property is cost. A lot of taxpayers, when they're purchasing an asset, borrow money in order to acquire the asset. Is that debt included in the basis of the property?
Yes, as a general rule, the taxpayer's cost basis includes the amount of debt incurred to acquire an asset. And the debt can be borrowed from a bank, from a third party, or from the seller of the property. For example, let's assume that a taxpayer purchases a $500,000 home by paying $100,000 in cash down and borrows the remaining $400,000 from a bank. The taxpayer's cost basis on the home under Section 1012 is $500,000. It includes both the amount of cash and the amount of debt incurred in order to acquire that home. That result is supported by the US Supreme Court's decision in the Crane case.
So by giving the taxpayer basis for the amount borrowed that went into purchasing the property, this ensures that when the taxpayer sells the property, the taxpayer's gain for tax purposes will mirror the taxpayer's economic gain. The same principle applies when the taxpayer actually borrows the money to purchase the property from the seller of that property, what's sometimes called a purchase money mortgage.
The same principle will also apply if the taxpayer acquires property subject to existing debt. For example, let's assume that a taxpayer purchases a $500,000 summer home by paying $100,000 in cash down and assumes $400,000 of debt that the seller took out to acquire the property. Well, as before, the buyer's cost basis in the home will be $500,000. It includes the amount of cash paid plus the amount of debt that the taxpayer assumed to acquire that piece of property. The buyer is still obligated to pay $400,000 of debt on the property, so we need to give the buyer basis for that debt assumed.
So far, we haven't raised the distinction between recourse and non-recourse debt. Recourse debt is debt where the borrower is personally liable on that debt. Non-recourse debt is where the liability is limited to the property that is securing that debt. And the general rules that we've been discussing so far apply whether the debt is recourse or non-recourse.
Now let's turn to the effect of debt on the disposition of property.
Code Section 1001 provides the rules for gains or losses on dealings in property. It provides that the gain from the sale or other disposition of property is the excess of the amount realized over the adjusted basis, and then vice versa for loss. The loss is the excess of the adjusted basis over the amount realized. And please watch our video on computing tax gain and loss. Code Section 1001 also defines amount realized. Section 1001B provides that the amount realized from the sale or other disposition of property is the sum of any money received plus the fair market value of property other than money received. How are liabilities treated in this equation?
When a taxpayer sells property subject to debt, the amount of debt assumed by the buyer is included in the seller's amount realized.
That's in Treasury Regulation Section 1.1001-2, Discharge of Liabilities. Section 1.1001-2A provides for that inclusion, and it says that subject to some exceptions, the amount realized from a sale or other disposition of property includes the amount of liabilities from which the transferor is discharged as a result of the sale or other disposition.
For example, if a taxpayer has $400,000 of debt on a home and sells the home for $200,000 in cash, and the buyer assumes the $400,000 of debt that exists on the home, the seller's amount realized is $600,000. It doesn't matter whether the buyer strikes that deal or instead pays the seller $600,000 worth of cash, and the seller then uses that cash to pay off the mortgage. Either way, the seller ends up with $200,000 worth of cash.
The same rules generally apply if the debt is non-recourse. And again, non-recourse debt means debt where if the borrower defaults, the creditor only has recourse to the property securing the debt. But an exception arises where the debt exceeds the fair market value of the property at the time of purchase. And this happened in the 1970s and 1980s with the individual style tax shelters, where you had buyers taking on a large amount of non-recourse debt that probably they did not intend to repay, but they were using that to get a high basis in the property, to claim depreciation deductions, and also take large interest deductions on the loan and benefit from tax credits as well.
For example, let's assume that a piece of property is only worth $100,000, but the seller prices it at $500,000. The buyer pays $150,000 in cash and borrows $350,000 from the seller, secured only by the property. So it's non-recourse debt. Is the basis $500,000 if the buyer likely will never pay back that loan? Under the estate of Franklin line of cases, a court will likely ignore the debt or limit the property's basis to the fair market value of that property at the time of its purchase. This has been the federal income tax treatment of debt. Thank you for joining us as you break into tax.
Break into Tax is trying to build a subscriber base, so we always appreciate new subscribers, likes of our videos, and when you share them with your friends.
I don't know why I'm having so much trouble. Take 179. Were you practicing law in the 1970s?
I was not. I have gray hair, but I'm not that old.